Okay guys, so we've got a highly requested video today. A lot of you have been asking me for a long time to talk about some stocks that trade at lower share prices. Now obviously, stocks that trade at lower share prices, it does not mean that they are cheap or that they are expensive. To determine that, you would have to actually value a stock, depending on a few different factors. So if you don't know how to value stocks, I'll leave you a link down below where I teach you how to value stocks. It's very easy and you'll pick it up right away. It's just a video. But in today's video, we're going to be looking at 3 stocks in particular that trade for less than $5 a share. And they are stocks that I actually do track on a regular basis. Having said that, I did actually want to talk about some other stocks as well, but I didn't want the video to be too long. So if you guys want to see another video of another 3 stocks that trade for less than $5, let me know down in the comment section or by hitting the like button. If this video does well, then I'll know that you guys want to see that video, and I'll be sure to make that for you guys in the future as well. Okay, and before we start, just got to say one last thing. I am not telling you to buy any of these stocks. These are very speculative, very high risk stocks. So if you want to gamble on stocks that trade for $5 or less, that's your choice. I'm not telling you to do anything. This is just kind of a fun topic for the channel to just kind of look at some different stocks, and we're just gonna have some fun and see what's kind of out there and see if any of these stocks have any kind of potential to be bigger in the future, or if they're just gonna continue to struggle. But again, usually stocks that trade at these prices, it's usually not profitable companies, usually companies with very small kind of track records, so they're very risky, very speculative. Make sure you do a ton of research before you even think about buying any kind of speculative stock. And I'm not much of a speculative investor myself. I only put less than 10% of my portfolio into spec stocks, and the majority of that is Tesla, which I think a lot of people don't even consider Tesla to be speculative. So that kind of shows you how little of a speculative investor I am myself. But anyway, that's just kind of some of the things I wanted to get out of the way. I hope you guys enjoy this. Should be a very fun video. Let's go ahead and get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. Okay, let's go ahead and start with stock number 1. And by the way, I'm going to be using some code words here, like some abbreviations, because there's certain terms that you just can't say on YouTube, like the algorithm will mess with your channel. So anyway, this is a stock that I've actually thought about purchasing myself in the past, but I was just never courageous enough to do so. And they are a huge play on the growing MJ market, so I think you know kind of what I'm talking about. And this company is Aurora. Ticker symbol is ACB. So let's take a closer look at this one. Okay, now I am technically cheating a little bit with ACB because the stock is trading just a little bit above $5, but I decided to include it anyway. But despite getting heavily beaten down in the past year, their stock is actually up an enormous amount over the past 5 years at a gain of over 800%. But from their 52-week high, the stock has crumbled by around 55%, and this is a trend that we've seen across the sector, given that MJ stocks were widely considered overpriced and are now starting to come back down to a little bit of a reality. In any case, ACB is my favorite play on the industry because of their enormous production capacity, as they are one of the largest growers in the world, but also because of their growing popularity. Now, taking a look at that capacity, they're one of the largest producers who is already doing around 150,000 kilograms a year right now, but that is expected to dramatically climb to over 625,000 kilograms in over the next year or two once their network of facilities reaches full capacity. Much of this is thanks in large part to some major acquisitions and expansion projects that on the negative side did result in shareholder dilution, but on the positive side have expanded ACB's reach outside of just Canada to several other markets internationally as well. But taking a quick look at that share dilution, we can see that in 2017 their shares outstanding increased by over 116%, and then last year they increased by almost 70%, and then in the last quarter they increased by over 100%. So that's really kind of a negative for the company because it dilutes investors' shares, and then it also hurts the company's EPS numbers as well. But going back to the fact that they are expanding internationally, we can see that they've already made 18 acquisitions since 2016, And the result of that is that they currently operate in 5 different continents and 25 different countries with 15 global production facilities. Ultimately, I think this enormous expansion will lead to a strong kind of global presence in a market that is growing by billions of dollars a year, according to Statista. However, despite all of the potential that they have, there's just no way that I've ever been able to make sense out of their valuation. They're not currently profitable, but according to Seeking Alpha, their price to sales ratio is over 30 forward. That is insanely high. Usually you want that number to be a lot closer to 1 if you're looking for any kind of value. So a forward PS ratio of over 30 is very, very high. On the other hand, defenders of ACB and other similar stocks in the industry would argue that because they're growing at such a high rate, their current valuation doesn't really matter because they can potentially grow into it later. I personally disagree with them when you're talking about a forward PS ratio of over 30, but to be fair to their point, ACB is at least growing their sales by hundreds of percent every single year and are expected to continue doing so well into the future as well, with growth of nearly 400% this year before slowing down to 165% the year after. Don't get me wrong, that is absolutely high growth in a market that I fully expect to be insanely larger in the future. So again, maybe there is some logic to the reasoning of ACB bulls. But another issue to consider is that most of these companies in the industry are not profitable and they continue to lose large amounts of money every year, with ACB alone expected to lose another 400 million Canadian dollars in free cash flow this latest fiscal year, although it's expected to slowly improve over time. And that's ultimately what I keep coming back to with ACB, is that you really have to believe in the company and realize that you are taking a little bit of a risky shot with them if you want to buy the stock. Now, having said that, if you want to still have a pure play in that particular market, you want to be a part of that MJ market, then ACB is definitely a stock that I think is worth keeping an eye on and researching further at the very least. Now, if you want to take a little bit of a safer approach, you could also take a look at some MJ ETFs, which I have talked about previously on the channel. And there are also some indirect plays on that market like Constellation Brands and Altria. Some of those stocks also pay some very nice dividends as well, and they have much more diversified businesses also. So there's definitely a lot of options out there. But if you want that kind of pure play, ACB, again, I think is a stock to at least keep an eye on because I think they are going to be one of the bigger players in the future. And again, this market is growing by a huge amount, and I think it's going to get a lot bigger in the future. Having said that, I still think the valuation is too high for me to get involved at this time. But when you look at those enormous growth rates, you have to, for me, I can kind of imagine them kind of growing into that valuation in the future. So I just want them to kind of come back down a little bit more to reality. But if they were to do that, then, ACB, if I really wanted a pure play on that market, ACB is definitely a stock that I would consider. Anyway, that was stock number 1. Let's go ahead and transition now to stock number 2. Okay, guys, moving on to stock number 2, we're going to go with a company that I've always found very interesting. Never invested in them myself, but I do find them very interesting. And they are a sort of security and crime prevention company, which I think is going to be huge in the future. And that company is, of course, Patriot One Technologies. Ticker symbol is PTOTF. Now, this is a Canadian company that develops radar systems that detect concealed weapons in public locations through a combination of hardware equipment and computer software. Their flagship product is called PATScan, and the way it works is by transmitting radar waves that are quickly analyzed by their software to detect a range of different weapons, and then their system alerts security, letting them know about the possible threat. And I really think that this is the future that we're probably heading towards. I really think that the future of security is going to be all about prevention through the use of technology. And it seems like that's exactly what Patriot One is focusing very heavily on, as they've even worked on ways to detect liquid explosives, as well as unusual behaviors from both humans and even vehicles, which I think is pretty fascinating. And many would argue that this is very important technology considering the rise in mass, I got to be careful with the words I say here on YouTube, but the rise in, the mass, But those are events that are often talked about on both sides of the political spectrum, so using new technologies like Patriot 1 may be beneficial. Although I'm not sure how healthy it is to get blasted with radiation every time you walk through a scanner, but that's a debate maybe for another day. In any case, there seems to be a lot of potential here for Patriot 1, considering that the global public safety and security market is expected to grow from around $300 billion last year to as much as $767 billion in 2026. So if Patriot 1 was to get just a tiny little piece of that, the benefits could be enormous. But unfortunately, that brings me to the reason why I've never personally felt confident enough to buy this stock myself, and that's because the company doesn't generate any sales, at least not yet. When looking at their profile on Yahoo Finance, you can see that they have zero revenue for each of the past 3 years, and even when looking at their most recent quarters, the story is exactly the same. Yet when you look at their net income to see how much money they've been losing, it looks like they lose millions of dollars every single quarter, so there's almost no way of valuing this company other than by looking at their future potential. And don't get me wrong, there are still some bright spots here, like a number of recent big name partnerships in areas like security and artificial intelligence, and just about a month ago they announced that they're going to start international sales as well, which when combined with their North American sales, it could be worth over $8 million in commitments over the first 3 years. And that's obviously not including any new contracts that can pop up at any time and kind of pile up on each other. But according to their announcement, it also says that their products should have shipped out last month, so that's another positive sign signaling that they should be making some progress. Not to mention that just a few days ago, they also announced a new partnership with Blue Tech Park Las Vegas, which is a $7.5 billion mini city project that is set to be the world's first net zero, smart, connected, and safe city. So that could also be a big play for them as well. So I think what you have here is a company that is literally in the very early stages of their business, and because of that, it's very difficult to value the stock. So I think until they really start generating some sales in a meaningful way, I think investors are always going to be very hesitant to be jumping into the stock. However, once they start generating sales in a meaningful way, if they do, and they have more and more contracts just kind of piling up on top of each other, then you could potentially see a strong rally in this stock, because then investors would start to gain some confidence, and then it could really, perform well. But until that happens, this really isn't a stock that I see performing well until it gets some momentum and we start actually seeing some sales. And at this point too, you have to remember, even when we get those sales, this company has really no experience in being profitable because they've just been losing tons and tons of money. Obviously, again, they're in the very early stages of their business, so it's going to take time. That's understandable, but they have no track record. So because of that, I think even in the early kind of stages, even when they start generating sales, there's still going to be a little bit of a pushback, I think, from investors. But it's going to be very interesting to watch. It's not a stock that I'm willing to buy at this time, but it's one that I always keep a very close eye on. And if I see some more developments happen in the future, then maybe I'll do an update video and I'll let you guys know if I'm willing to take a chance with this one. But anyway, that was stock number 2, Patriot 1 Technologies. Let's go ahead and transition out to stock number 3. Alright guys, finishing up here with stock number 3, we're going to go with a Chinese stock that I almost never hear anybody talk about, but because they've been growing at such a high rate in terms of their sales, they caught my attention a little while back, and I've been just kind of tracking them ever since. But this is, again, a Chinese stock, and this is a company that has a name that is very difficult to pronounce, but I'm just going to do my best here. The name is Qiao, and ticker symbol is QTT, so I'm probably just going to be using their ticker symbol to talk about the company. Now, taking a look at their bio, this is a company that focuses on mobile content platforms with their flagship application called Qiao that translates to fun headlines in Chinese, and it uses AI algorithms to entertain their users and push out certain articles and videos based on their interests, their behavior, and their custom profiles. And they basically generate their revenue through digital advertisements. And speaking of revenue, their sales have been absolutely on fire. But before we take a look at that, let's take a quick look at the stock. Currently, they trade for a little over $4 a share, which is actually a huge drop from their previous highs of over $20 a share. So they've basically crashed by around 80% during that time, which is unfortunate because before the crash, this was a new IPO stock from China that was having an amazing start to the year. In any case, the recent crashing has a lot to do with the struggling Chinese economy, as we've seen similar big name companies like Baidu crash due to weaker spending on advertisements because of very low consumer and business confidence that is taking place in the country right now. But the sell-off was also fueled even further when they announced a secondary offering earlier in the year that they priced at a lower price than what the stock was currently trading for, and investors didn't like the further dilution. In any case, the escalating trade war has only made things worse, and the company has struggled to recover ever since. However, that may actually be good news. Just a couple months later, they announced a share buyback program of $50 million to take advantage of the lower prices. To me, that shows a lot of confidence in their business, considering that they were selling shares just a couple months prior and are still not even profitable. In fact, the only way to really value them is through their sales, but what I found is that their PS ratio is actually not that bad at around 1.55, which is also a bit less than the industry median of 2.2. A big reason for this is because, like I mentioned earlier, their sales have been absolutely on fire. According to Yahoo Finance, they grew their sales by almost 800% in 2017 and close to 500% in 2018. And even though those rates are expected to come back down to reality later this year, they are still expected to continue growing at some very high rates in the future, with sales growth of 87% this year and 50% next year, breaking north of $1 billion. Their EPS is also expected to grow by only 5% this year, but then almost 50% the year after. Those are definitely some very high estimates that will be difficult to hit, but they may actually not be that far out of reach, considering that in their last quarter, they grew their daily active users by over 200% year over year to over 37 million people, with each of them spending over an hour on the platform every single day on average, meaning that the business is looking pretty sticky, at least at this time. And when you consider that there are over 1.4 billion people in China, and that digital ad spending in China is expected to continue growing by billions of dollars every year, and that China also has the highest number of cell phones being used in the world at 1.3 billion, I'd say that there's still a lot of growth potential left out there for them. The only question is, can they actually capitalize on that potential? It's still way too early for me to even consider this stock because I still don't really know a lot about their business, and I don't know a lot about their market and their competitors. And I don't like having a lot of exposure to the Chinese market because it's difficult for me to get a grasp on what that market is like, what the consumer is like over there, what businesses are like and how they function and all that kind of stuff. Over here in the States, it's a lot easier for me to understand everything. So I don't like having a lot of exposure to China because of those reasons. Also because of the VIE structure, but I think more so those other reasons that I mentioned. But when I look at some Chinese stocks, a lot of people are extremely bearish on Chinese stocks right now. And it kind of reminds me of like the last recession, or a market crash where people are just so negative and they see stocks falling and they don't want to buy them because they see them falling. They just think that they'll get worse and worse and worse. But when we get a trade deal done, and if Chinese stimulus starts to work for them, and consumer confidence returns and business confidence returns, we could really start to see a lot more spending from businesses, and that's definitely going to increase digital ad spending as well. So a lot of these kind of internet-based companies, I think, could potentially do very well in the future. I'm not saying that'll happen with this stock. This is a very high risk kind of speculative one, but when I look at some other companies, some more proven ones like, well, I don't know. I personally like Alibaba and like Tencent. But anyway, even when I talk about those stocks, a lot of people are very negative on just a lot of Chinese stocks in general. So it's just something that I find kind of fascinating. But anyway, this is a stock that I will continue to track and keep a very close eye on. It's still just way too risky for me to pick up any shares. I would have to do so much more research before I even consider this one. But I will be researching it more, and I will be tracking it. But anyway, it's one that I definitely find interesting. By the way, you might be wondering why I didn't mention NIO in today's video. And the reason why is because we've talked a lot about NIO in the past, and I wanted to show you guys some different stocks in today's video. So that's why. But if we do another 3 stocks under $5, I'll include NIO in the next one, and I'll give my updated thoughts, because it is actually a stock that I do own. It does trade for less than $5. It has been horribly performing recently. It's just been really crashing by huge amounts. Had like a decent start and then just came crashing all the way down. It shot up a lot and then it crashed all the way down. Very similar to QTT actually. But it's a very tiny position in my portfolio. It's like less than 3%. It's actually gotten smaller over time. But it's just kind of a gamble on the EV market in China for the long term. It's not a stock that I take very seriously, but it is a stock that I actually own myself. So it is one that I think would be fun to include in the next video and give my updated thoughts on it, because it has been crashing by huge amounts. So anyway, that's just kind of everything that I think I needed to mention. I hope you guys enjoyed this video. If you did, hit the like button. Thank you so much for watching, guys. Thank you for all the support. Really means a lot to me. And I'll catch you guys in the next one. Take care. Oh, and by the way, let me know your thoughts down below on the stocks we talked about today. And let me know if there are any other stocks that trade for around $5 or less that you guys track very closely. And let me know about them. Maybe I'll cover them in a future video as well. So anyway, that's it. Thank you for watching. Take care, guys. Bye-bye.